So remittance reports are reports that we get each month after loan servicers collect payments from borrowers. We get statistics for each pool of loans that we own, whether it's on subprime auto, prime auto, or unsecured consumer loans. Within those statistics, we get 30, 60, and 90-day delinquencies, along with defaults, severities, and some other metrics. And watching for trends in these metrics can give us a good view on the health of the aggregate pool of borrowers, and can also help us see where pockets of weakness or strength are developing, and within what borrower or consumer cohort we're looking at. So what is the data telling us right now? So it's a bit of a mixed bag. Within consumer unsecured loans, broadly speaking, delinquencies and defaults have been fairly benign and in line with the pre-COVID averages. But the metrics are certainly issuer dependent in terms of performance. Unsecured consumer lenders have been quick to tighten their credit boxes after the inflation bout started to take hold in 2021 and 22. And when comparing to late 2023 and 24, delinquencies at 4%, defaults trending a little bit lower towards 8 or 9% are levels that we're ultimately comfortable with given the structural support that ABS provides. Autos are a different but a little nuanced story. In the prime auto space, delinquencies are sub 1%, defaults are in a very manageable position at 2% or less. The prime borrower is in a very strong position as evidenced by other metrics in the form of other debt such as prime and non-QM RMBS. In subprime auto, however, there have been a lot of media headlines over the last couple of years that subprime auto delinquencies are at all-time highs above GFC levels. And while that's true, with 60-day delinquencies just over 6%, corresponding defaults and accumulated net loss levels are not as elevated as they were pre-COVID. In fact, defaults are fairly in line with pre-COVID averages at just over 12%. Again, there's enough structural protection in ABS deals to support this. Further into the nuance, the vintage year does matter quite a lot here, and we see some worrying signs for the 2022 and 2023 vintage, with defaults already over 15%. And we're also seeing some slightly elevated levels of delinquencies and defaults from the 24 vintage, with defaults right around 15%. Now, since then, lenders have started to tighten their credit boxes, and early signs from the 2025 vintage on loans look a lot better, with delinquencies at 4%, defaults around 9%. So all in all, this data is telling us that the bifurcation of the performance between these two borrower groups further cements the sort of K-shaped recovery consumer narrative that we've been hearing over the last couple of years. So why is tax season the true test for consumers? Well, there's a fairly typical seasonal pattern that we see in consumer-based loans like subprime auto and consumer unsecured. Delinquencies usually rise after the holidays, after some elevated spending. We typically see a commensurate decline in those delinquencies after consumers get their tax refunds and pay down debt or catch up with payments to become current again. Now, if delinquencies and defaults stay elevated or don't decline as much as we hope to see, we'll be a little bit more cautious on the lower leg of that K-shaped consumer. So what we'll be watching for specifically, we'll be looking at early cure rates, 30-day and 60-day delinquencies going back to current. And also we're going to be looking at whether or not delinquency roll rates are slowing. So for example, the percentage of borrowers rolling from 30-day delinquencies into 60-day delinquencies. And ultimately, we're not looking for perfection, but we are looking for some healing here. So the bottom line is that rising delinquencies definitely worry us, but we're not ready to hit the alarm button yet. If delinquencies don't heal after tax season, that's when we'll likely become a little bit more cautious on certain segments of the consumer population.